CommitToWealth.com, creating a legacy by committing to real estate wealth.
Commit to Wealth Nation, welcome to the Commit to Wealth podcast. I'm your host, Juan Vargas. On today's show, we have Todd Dexheimer. Todd got his start in real estate in '08 and is now a multifamily syndicator and controls over 550 units throughout 5 states. He has flipped over 150 homes and has owned many rentals. He's the founder of Venture D Properties and is the host of the Pillars of Wealth podcast. Todd, welcome to the show.
Yeah, thanks for having me on. I appreciate it.
Hey, it's a pleasure to have you on. I've listened to your podcast many times. I've seen you all over Bigger Pockets. You're always providing a ton of value, man. So, it's really is, it's a pleasure to have you on here, and finally get a chance to talk to you, So let's get right into it, man. Who is Todd Dexheimer?
Well, first of all, appreciate you listening to the podcast and hopefully providing good value there. And
oh yeah, definitely.
You doing your podcast and providing awesome value as well to your listeners. So, who am I? Well, I'm father and husband. I got 2 kids, and first and foremost, a family man. And then I'm also what most people want to hear about is a business owner, and I run a multifamily syndication company. I've got do some coaching and mastermind groups as well. And I've also got a contractor's license, which I don't do a ton with, but I do some, we do some projects with that as well as opportunity basically comes to us. So that's kind of where I'm at right now. The multifamily syndication is my main focus. Looking at value add multifamily in several different states.
Nice. So you had a pretty interesting beginning. I kind of want to, go into that, really quickly and tell my audience, what your beginning, because everybody is in a different situation when they start. For everybody, it's a different reason why they start. Tell us, what your beginning was and why you started. What was your why?
Yeah. So sure. I was a teacher, went to college, got the degree, became a teacher, and did that for a few years, for 5 years approximately. And while I was teaching, I knew that teaching just wasn't for me. So I was kind of in the search almost right away for what I really wanted to do. And honestly, it wasn't, the why wasn't this like big, financial goal. I mean, that sure is nice. But the why was I wanted something that I was just passionate and excited about every single day. And I wanted to do things that made a difference. And that's one of the reasons why teaching was attractive to me. But I just found that it wasn't what I thought it was. It wasn't making the difference that I thought it was making. I was very limited to who I'm affecting. And they didn't have a choice. So therefore, a lot of them just weren't going to be positively affected by me no matter what. So it wasn't quite what I thought it was going to be. And so I was basically doing, the soul searching thing and trying to figure out what's next, what do I need to do. And real estate really was attractive to me. So as you said, I started in 2008 and I always wanted to buy multifamily. I always wanted to have a large portfolio of multifamily. That's honestly where I started. But I didn't have really any money. So I started with some fix and flips and some rentals, but they're, single family rentals. So I was buying the 1 to 4 family. I was using every last dollar I had just to buy my, first 1 and 2 but then flipping came into the picture, and I was able to then flip several properties, and then I would buy one to keep. And so, and mind you, this was 2008. So, great timing. Although at that time, that couldn't be further from the truth. I mean, most people thought you were crazy if you're in real estate in 2008. Most people thought it was a big mistake. I mean, So yeah, in hindsight, people go, wow, you got lucky with timing and so on. But it was, you had to take action, and most people just weren't taking action. That was probably the biggest reason why there was so much opportunity. So I did the flipping. I flipped, as you said, about 150 houses. I had a 1 to 4 family rental portfolio, about 75 units at one side, 75, 80, somewhere around there, units at one time. And did that for quite a while until I actually had a partnership, and we ended up splitting. And that's when I started doing the multifamily stuff.
Gotcha. So you did, you had a pretty, I guess, humble beginning, as most of us do as well. So I really do like that story, man. It's pretty awesome that, you found something that you wanted to do and you went for it. And that was the biggest thing, is the action. You've heard it many times over. That is really what separates, successful people from not successful people. Is just the education part, and then the action. Education, the action. You got educated and you took action. So tell us about your first multifamily property. Where did you find it? How you took it down. Where you sourced the capital, the equity, and just kind of go into the details on that.
Yeah, well, real quick, if I can remind what you just said, I just want to emphasize on what you said. And it's so true. I hear it from so many different people. And, I wish I would have, I knew the timing was there. I wish I would have taken action. I wish I would have done something. And so you hear so many, I wish I would have. And that's really important as people are listening to this. You want to make sure that you're not looking back saying, I wish I would have. And I can still say that. And a lot of us can still say that, but I took action, and I wish I would have probably done multifamily sooner. So I can still say that. But at the same time, as you said, it's all about getting yourself educated, but you can be super educated, and if you don't take action, it doesn't mean anything. So get yourself educated just so you're smart enough to where you're going to eliminate some mistakes, not all mistakes, because that's just never going to happen, and then take action and move forward.
That and now while we're on that subject, you're entirely right, Ben. A lot of people, they focus too much on the education side of it, and as we both just said, it's very important that you educate yourself, but you said it right now again, you have to do it to the point where it's just enough, because if you over analyze, then you're never going to get anything done, so it's got to be just enough. And like you said, there's going to be mistakes, but that's how you're going to learn, and you're going to move on, and you're going to be better at it. So we all know education hoarders, right? They just go in, they're the ones that are buying all the courses at the real estate meetups, and they went to the wholesaling and the flipping and the multifamily and the self-storage and all those kind of courses, and they still don't take any action because they've got to be perfectly educated before they take any action, because they don't want to have any risk involved. And that's just not reality. I mean, you can't ever educate yourself out of risk. It just doesn't happen. Yeah. And then, real estate investing is a risk in itself. It's just, as you said, it's just not going to happen. I think, the key to that as well is being around the right people, people that are action takers, that are successful in getting things done, be around those guys, and learn from those guys. And, you'll be doing the same thing, shortly thereafter. No doubt.
Yeah. And look for base hits. Don't look for home runs. If that's what a big mistake beginners make, is they always look for the home run because they see somebody else has been successful and they want to get there super fast. And so what do? They look for the home runs, and then they make a mistake, and then they go down.
Yeah. And, you got to be able to make, $50 before you make, 20,000, a month. You got to learn to make the $50 to $100 a month, on that same kind of subject, while you're there as well. Yep. Singles, base hits, doubles. So, yeah. So, tell us about that first deal that you got into, your first multifamily deal, man. I'm interested to learn a little bit more about that.
So I've done what I would say two first multifamily deals, right? So when I was doing a lot of flipping and buying single families, 1 to 4 families, I did end up buying a 15 unit that you could call a multifamily building, but I didn't really do it right. And it worked. I made good money. I made my investor decent money on it as well, but it wasn't really the multifamily that I think of today.
So, I mean, why not? Tell us a little bit about that one. I know you kind of want to avoid that one, but that's how we learn from them. That's how we learn. So tell us about that, 15 unit real quick.
Yeah, it probably actually held me back, quite frankly, because I bought this property. It was a deep value add property, and there was a short sale that I purchased in St. Paul, and it just needed a ton of work, and it was in a D class area, which is a big mistake. But I just saw the potential value that it had, which it did. I ended up doing really well on it in the end, but it just had so many mistakes throughout the project that it didn't go probably as smoothly as planned, and really derailed, I think, myself moving forward with more multifamily. So I purchased this property, like I said, at a short sale. I budgeted a bunch of renovation to do I needed a new roof and a lot of like brickwork and just interior work, and things just ended up costing a lot more than what we planned. So we didn't really achieve the increased rents that I thought I could. It was very hard to get the property stabilized. When I bought it, I think there was only like 4 or 5 units occupied out of 15. And I thought it would be really easy to get it to 14 or 15 units occupied. Well, that was very, very challenging because of the type of property it was, D-class property. Very challenging to get 14 or 15 paying tenants in there. And then there was a lot of plumbing issues. This thing was built in 1886, had old plumbing, old boiler, old radiators, all that kind of stuff. So we always just had a lot of maintenance issues that didn't allow us to cash flow. So during that hold period, I think it was about 2.5 years, we cash flowed very little, probably a total of like 8 to 10 grand. And ended up selling it and then made some good money on the sale. Still ended up getting like a 30% return on our money. So it ended up working out really well, but it was just a pain in the butt the entire time. I remember it was my wife's birthday, and pipe burst, and I couldn't get a plumber. I was self-managing at the time. So I had to run over there, and she had to finish cooking her dinner. I was supposed to be going to a Minnesota Wild game. We had another pipe burst there. So just all kinds of stuff that this thing was a management nightmare.
So two things on that one. One was that you acquired this property in a D-class area. So D-class, that's a no-go. First and foremost, I would say that when you're looking at different properties, make sure that you focus on the market first and then the property. That's kind of the way I do things, at least. The market or sub-market and then the property itself. And second thing to that was it was an older property, 1886 you mentioned. So, there's definitely going to be a lot of, things that are outdated and a lot of things that are going to be needed to get addressed. So two things that can really wipe you out. But you seem to actually, learn a lot from it, and you still ended up cash flowing. Very minimal, but you still ended up cash flowing. Somewhat still. I think a lot of people out there, could have been wiped out, completely. But it just goes to show, some operators can cash flow even through self properties, and others just cannot. And even though it was 8 to 10 grand, you still managed to get those 8 to 10 grand, and then at the end, still be able to sell it, for a good profit. So
we had some fun along the way, I guess, if you want to call it fun. But yeah, you pointed out a couple mistakes. I'd say the other one is I tried to self-manage it, and I didn't have the systems set up. Now, self-managing is okay if you have the systems set up, but I didn't have anything set up properly. So self-managing was just a lot of banging my head against the wall type of thing. That's not how you do it. So I should have either hired a third-party property manager, or I should have actually set the systems up and really focused on the property management aspect of that property. Because we probably could have gotten, at least 12 or 13. I think at one time we did have like 12 units occupied, but not for very long. So we probably could have kept it full and done a little bit better job, and maybe even made some more money on the sale had I actually spent some time with it.
And the other thing that you said as well is that it was difficult to get 14, 15 paying tenants. So were those 12 paying tenants, or were they were just bodies like there?
Well, yeah, I mean, and that's why they weren't for there very long. I think, like I said, this was a while ago, so my numbers might be off a little bit. But let's just say we had 12 tenants. We probably had 9 or 10 tenants that actually paid. The other ones, they were only there for a short period of time,
a month or two, and that's it.
Yeah.
Okay, cool. So very interesting, and thanks for sharing that. So what was your first or more successful property after that?
Yeah. So again, I've been in phases of multifamily. So my next kind of property was a 22 unit building I purchased with a partner, and that one we purchased on a land contract from the property owner. Actually got 10% down, which was fantastic.
Nice.
I got really good terms, and just recently sold it and made a really good profit on that one as well. The cash flow there struggled a little bit, but I knew it would. And we were able to kind of right the ship, prior to selling, which we knew the cash flow was going to be struggling throughout. I did have some management issues with third-party property management that maybe knocked it back a little bit, timeline back a little bit. But other than that, things went pretty well there, especially at the sale.
Why did you think, or what did you know that the cash flow was going to struggle?
So I bought it 9 out of 22 occupied units.
Gotcha.
So it had very low occupancy at first, so the cash flow wasn't going to be there for quite some time. We had to do a lot of renovation to the units itself and get the property back up and going. And then, like I said, we had some management issues that probably pushed that timeline out by quite a bit. Maybe almost doubled the timeline due to some management issues.
So what type of financing did you have for that one? Like, in place, was it a bank, a local bank, or was it like a bridge?
It was a contract for deed, or land contract the whole time.
Oh, the whole time. Gotcha. Because you did mention this.
Yep. So the seller financed the whole thing. The funny thing is, so I went into this property. So this was an off-market deal. He had another property listed that was an 11 unit, and I made an offer on that, but I also wanted more. So I offered on this 22 unit, and he wouldn't come down to my terms. And I figured out his motivation was he was retiring and he wanted to spend more time with his daughter and grandkids. And he didn't want to be on this property all the time. Well, he had, at the time, I think he had 10 out of 22 units occupied. So I knew he wasn't cash flowing very well. He didn't have a mortgage on it. So he's probably making maybe $1 or $2 on it. But really not making anything, maybe even losing money. So his motivation wasn't the cash. He didn't need the cash today. He wanted actually to make cash flow. That was the goal of these properties. So that's why I offered this land contract, and I ended up getting it for the price I wanted because of the land contract, not in spite of the land. Usually you think, well, I'm going to have to offer them more if I'm going to do a contract for deed land contract. In this case, I actually was able to get it for less because of seller financing, because now he knew he was going to make $2,200 a month every single month without doing any work. And that is pretty appealing for somebody who wants the cash flow but doesn't want to deal with the headache and the hassle.
In this case, you took a little bit of a hit, right? It seemed like, at least, at the very beginning, because you weren't necessarily cash flowing. So you might have, been able to get better terms, through a lender, where you could have had a little bit more cash flow. But you listened to what he wanted, right? And then you gave him what he wanted.
Quite frankly, I wouldn't have been able to get better terms with a lender. I got this property for $435,000, and I got a 5% interest rate at a 25-year amortization, which I don't think any lender at the time would have done it for much better, if any, because of the occupancy status on it. 9 out of 22 units. Lenders aren't too excited about something like that. So I was able to get really good terms still. And yeah, you're right. I mean, the occupancy and the cash flow struggled, but we planned on that. So that was out of the beginning, that was a plan. We knew we were going to be losing money from the start. So we actually had the money ready for it.
Gotcha. So yeah, it was a play where it was going to be low cash flow, but then there was going to be some light at the end of the tunnel, and it definitely was light, with the sale here recently as well. Okay, gotcha, man. And both of these properties were right there, like in the Minnesota area, or where were these? One of these?
So yeah, the first one was in Minnesota. That was in St. Paul. And the second one was actually in Cincinnati, Ohio.
One in Minnesota, one in Cincinnati. Tell us real quickly, what are you doing as far as to minimize your risk when finding properties that are out of state, right? Because they're not in your backyard, So and they're smaller properties at that. So it's not like you're taking down a 150 unit like on that one. Your second property wasn't 150 unit or 100 unit. So tell us a little bit about that.
Yeah, very challenging. And actually, now my focus is on 100 plus unit properties. And one of the reasons for that is because of the risk involved in out-of-state investing, and because the efficiency is so much better once you start getting larger properties. So,
right.
So for the smaller properties, there is, I would say, it definitely safer if you can do it in your own backyard. But so how do you minimize the risk no matter what? Well, first of all, you got to find a good, solid market. You want to find markets that can cash flow well. You want to find markets that have good growth happening and all the right fundamentals in them. Cities doing the right things. Cincinnati has, they got Ready Cincinnati, which is helping bring in businesses into Cincinnati, and really Cincinnati's been experiencing a lot of good growth. It's a good cash flowing market. Things have actually tightened up in that market just a considerable amount, which everywhere is the same. But Cincinnati, just a few years ago, you could find some pretty good deals. Now, very, very difficult to find good deals like anywhere else. But at the time, it was very good cash flowing market, and the fundamentals were right. And rent was increasing quite a bit, but it was still affordable for the tenants, which I really look at what the rent affordability is. Employment was growing, all that kind of stuff. So that's first and foremost. Second is, can we find good management companies? So you want to make sure you have several good management companies. I get a little nervous or get a little concerned with other people who are buying in these tertiary markets that have very low populations. If you get 100, 200, less than that, 1,000 people in it, well, how are we going to find good property management companies? And what if we have to fire a property manager or a contractor? Can we find somebody to take over for them? And the answer a lot of times is, well, no, not really. So we want to make sure we have good property management in place. The other thing I would say to look at is you want to be I would say in B class or better areas, especially when you're looking at these small properties, because property managers get paid on how much rent they actually can collect. And it's easier to collect rent in a B class than it is in a C class. And quite frankly, the rent is a little higher. So they're more excited to manage in B class. It's less work. They get more money. Everybody wants less work for more money. So it's easier to find good property management companies in B class or A class versus C class. So that's another thing with, especially with smaller properties. So those, I guess those are probably the main things. Can you find people to manage it? And is the city and actually area within the city, the neighborhood within the city, are those strong, and do they have good fundamentals?
Gotcha. Yeah, some very good points that you gave us right there. From the actual market itself, to finding strong property managers, to the right asset class. I mean, really, really good point. So, thank you for sharing that.
You have to focus on who's going to be running your properties. And I don't care how good the market is. If you can't find somebody to run your properties and do a really good job at it, it doesn't matter how good the market is. They're going to mess it up, and a good market is still going to be painful. So make sure you've got good, sound property management. I'd rather be in an average market, still with some growth, but an average market with very strong property management.
I agree 100%. It's about the property management, company that you bring on, because, a lot of people think about acquisition. People are always thinking about acquisition. Acquisition is the very beginning, and it's like this much of it. The whole period is where the money is made. So you can take a really solid property as you mentioned, and not manage it right, and it goes down the drain, Vice versa. You can also take, a property that's not as average, and then you bring in a strong management company, and then, they turn it into like the best property, like in that market, those are some really good points. So Todd, I want to, talk about like today, what has been, your latest deal, and what are you focusing on now?
Yeah. So I'm focusing on, like I said earlier, multifamily, value-add multifamily. My latest deal actually just closed on was a 224 unit deal in Tennessee. I actually partnered with a few guys on that one, which is a little more unique. Most of the deals I've been the only driver behind. This one, I actually partnered with a few guys that have a lot of experience within that market. I'm excited about that deal and the partnership, and really think the group that we've got together is going to make this deal a really solid deal. So that was the reason for the partnership. I did want to get into the market. Entering new markets is very challenging. So this was a very easy way to enter a market with people that have knowledge already in the market, have properties in that market. And it was, in my opinion, a great partnership to form. So that was the latest deal. It's a 224 B class value add. We're putting about 5,000-6,000 into the interior units, and then overall we're putting about $2 million into the property. So
the opportunity there was to implement a unit interior program. Is that what you're doing basically to this property?
Yeah, so we're doing two things. One is interior upgrades, and it was built in 1987, so everything's from 1987 basically. Mm-hmm. It's not super crazy outdated, but it's outdated enough to where tenants want something nicer in there. So your typical new flooring, cabinets, all that kind of stuff. And then the exterior, what we're doing is adding amenities. That's the biggest thing we're doing there. We got some landscaping stuff. We're going to be doing some retaining walls we have to repair and stuff like that. But the main thing is we're going to be doing some amenities that are going to really enhance the property. So dog parks, the old rec center that was there years ago burnt down and hasn't been replaced. So we're going to rebuild a nice office with a workout room and all that kind of stuff, and just really make the experience at the property a lot better.
Yeah, so it's all for the tenants, and make it a community versus just somewhere where they live. Make it a community and actually have a home feel. I really like that. So this was in Tennessee, a 224 unit. Okay. Mm-hmm. And so what markets are you looking at today? Like besides, Tennessee, I know you entered that market, but what other markets are you looking at today that you would like to enter?
Yeah. So very strong still in Cincinnati and then Lexington, Kentucky. Those two markets I like a lot. And then the surrounding markets like Louisville and Columbus and Indianapolis. I like those markets a lot. However, I don't have any properties in them. So right now my properties are in Cincinnati and Lexington outside of Tennessee. I also like, there's a lot of markets, quite frankly, I like, but it's all about, do I spread myself too thin? You got to be careful about doing that. And that's where that partnership came in. I think it really worked in really well. So I like, there's a lot of markets though. I do a lot of research on different markets. There's markets that I think are really strong. Some that I haven't completely done all my homework in, because there's a lot of things you look at, right? You look at, is the market strong? And then you have to decide, okay, is the market strong? Great. But is there truly opportunity for me to buy? Some of those markets I haven't figured that out, but I like Phoenix, Arizona. I like a lot of the North and South Carolina cities, although some of them I think are traps, like Fayetteville, and a few others that people just want to be in North or South Carolina because they've heard good things about it, and then they go and just invest in the wrong city. That happens a lot, quite frankly. People go, Ohio's great, and then they go invest in, I'll pick on like Cleveland, Ohio. They go invest in Cleveland, Ohio. Maybe it is great, by the way. I don't know. But they go invest there because somebody said Ohio's great. Well, Ohio's a big state, and you want to make sure that particular market and sub-market within that is good. So But yeah, those are kind of the markets I've been looking at: North South Carolina, Phoenix, Arizona, and a little bit in Florida, but I haven't really dug too deep into Florida yet as well. So right now, you just got to be careful. Obviously, we're in a environment where we're kind of in this uncharted territory as far as the economy goes. It's super strong. Everything looks good. Fundamentals look fantastic. It looks like there's no end in sight, but that's when it gets a little, in my opinion, a little scary. You got to be really, really careful and cautious, because when everything looks like it should go on forever, oftentimes that's when people put their guard down, and that's when things go wrong, is when people start putting their guard down. So keep your guard up. I think that's the most important thing, and really pay attention to what's going on, and make sure you're buying these properties with good fundamentals.
Yeah, some long-term debt, that's one of those for sure. Make sure you're conservative in your underwriting as well. So you gave us a lot of good information. If you could tell us one thing, the single biggest mistake that you have made in your career, that you can share with us, that will definitely help us out. Anybody out there listening, what is one thing that you would say today? And I know you've made some mistakes, and I think they're good. Mistakes are good. But what is that one?
I can't really pick out an event that's the one biggest mistake, because there's been plenty of different things that I've done, of course, throughout my business. But I think one of the bigger mistakes I've made is just trusting people, which you should trust people, but not having the right contracts in place. So I just trust people because that's who I am, and then I don't worry about the contracts. And then if something goes wrong, and that ends up biting me. So I'll give an instance. I sold the property. This is when I was back flipping. Mm-hmm. And I sold this property to a couple, seemed like a very nice couple. And then I ended up doing the rehab after they bought it, which I typically do, right? I would buy it, I'd do the rehab. And so anyways, so we had this contract, and me as the general contractor, and they were asking for all these change orders, and I was just doing these change orders, and they would email me a change order, but I would just do them without actually having the paperwork in place. And that ended up biting me in the butt. I lost about $70,000 on that deal because of those change orders and just basically how things went with the contracts there. And so that's a big lesson learned, $70,000 down the toilet. And that, shame on me. I've done that a few other times. Haven't had good contracts in place, and typically end up losing some money in those instances. So I've probably lost, I know I've lost well over six figures because of not having good, strong contracts in place. So now I always involve attorneys and make sure we've got good contracts in place. And, I don't want to get burned. And I want to make sure I think the most important thing, some people go, well, I trust you, I don't want to do that. It's easiest, we just do it on a handshake. Well, that's great, but let's make sure everybody's got the same expectations in place. And communication, is extremely important. And so a contract is a form of communication and a form of ensuring everybody has the same expectations in place. So that's where those contracts are really important, in my opinion.
Yeah, that is some really good advice, man, because I've also done transactions, to where, it was more of a handshake kind of thing. And luckily for me, I didn't get burnt. But I can see how, not engaging an attorney, this is one, many years ago, but, for trying to save some money and not hiring an attorney, you're doing these transactions, and, it's just a matter of time before, something happens and you get burnt, so, but you're right, having those expectations, the communication said on paper, to where everybody knows what to expect and what to expect from one another, so I like that.
Look, I've done a lot of work without contracts, and in 95% of the time or better, everything's fine. It works out, but you get that one person that is going to take advantage of it, or that just is, this couple they were they were slick. They knew what they were doing.
They knew what they wanted to do from the very beginning.
Yeah, they knew, and they knew how they could manipulate it and take advantage of it, and they were able to get away with it. So, because we didn't have the contracts in place.
Yeah, and all it takes is one, and you will learn your lesson, and you're not going to do the handshake anymore. You're going to do contracts from now on, no matter if it's with people that you really, really trust. You're still going to be doing it the right way. So,
yeah.
So Todd, it is time for our Nuggets of Wealth, and these are questions that we ask our guests every week. So hopefully they are able to help out our listeners. So question number one: what is a good tool, source, or platform that you use almost daily that can also help others?
I'm going to go a little old school here.
All right.
A notebook.
No way.
Yeah. Man. Okay. A notebook, a hard calendar. I think those are invaluable tools. Now I have my tech calendar, I have my calendar on my phone and on my computer, and they're all integrated and all that kind of stuff. But I think there's nothing better than a notebook to write down your thoughts, write down your goals, write down your action plan, and a calendar to write down some big events that are coming up. In my opinion, they can't be beat.
Yeah. And you're right. Look what I have here. And you guys that are listening, you can't see it obviously, but I mean, I have these little, sticky pads. And so I'm always, the little sticky notes, so I'm always, writing my little notes as well, and I don't put them all over the place, because then it gets too tacky, but I'm always writing something down. Any thought, like you said, it's always good to have it down, write it down. I like that.
We try to, I think, oftentimes focus too much on the technology and not enough on the implementation. And it's just, in my opinion, so easy to have something tangible. It's right there. It's easy.
Right there. Yeah.
I got it. And I don't have to worry about what app I'm using or so on. You got all these things, Slack and email and IM, and there's so many things, and we can all, use them. But to me, sometimes it's just less confusing to write it down on a notebook.
Yeah. Yeah. And I mean, you're right. It's just the simplest. It's right there. And you move on, it's quick and easy. What was the best business advice you ever received? I know you gave us, your mistake earlier, but what was the best business advice?
Yeah, I mean, I hear different advice all the time, obviously on my podcast and, through mentors and all that kind of stuff. I think the best business advice, the thing that seems like comes up over and over, of the difference between the very successful and everybody else, is focus, right? People that can focus, follow one course until success. Those are the people that have the most amount of success. So if you can learn truly how to focus and be involved in, deep work, as the author that writes that book, I can't remember his name. It's beyond me right now, but I think that's going to provide you with the most success. So focus. Yeah.
Don't be jumping around all over the place. Focus on one thing until you get it done, until you get it right, and you become a master at it.
Yeah.
The next question happens to be what book you're currently reading. I don't know if it was deep work or not, but is there a book that you're currently reading?
I think it's called The Power of Habits, I believe. I think it's
Power
called
Habits.
Power,
I think I've heard of that
Power
one.
Habits. It's okay. It's just pretty dry, so I'm not enjoying it as much as I thought. But I usually try to stick through a book when I get it.
Yeah, and for those of you out there listening, if you are reading a book and like as Todd just said, if it's a book that you find dry, then it's okay to put it to the side. I've done that plenty of times. When I'm reading a book, I'm like, all right, I'm done with this book. I'm moving on to the next one. Just move on.
Yeah, and sometimes you go back to it, and you really like it the second time, and I've done that before, where I'm just like, I can't read this stupid book, and I put it to the side, and then all of a sudden sit on my bookshelf, and I go, you know what? I'm going to pick that book back up. I was reading, I'm looking at it right now, Start With Why by Simon Sinek. I was reading that, and I I just didn't get into it, and I didn't want to keep on reading it. So I put it down, and about 2 years later, I picked it back up and I started reading it, and I actually enjoyed it. And I read the whole book the second time. And so sometimes you just got to put a book down and ignore it for a while. And for me, it was a few years, and I picked it back up and started reading it, enjoyed it. So you just never know.
I think a lot of that has to do with, sometimes a book's subject doesn't fit your life situation, at that time. And then later on, as you grow as a person, or your business or whatever, then it kind of, it relates more to you. Right. So the second time around, maybe that's why, it's like, okay, well, hey, I understand what you're saying here. I can relate, and, let me implement some of the ideas that you give us here. So that could be why. So where do you see your business in the next 5 years?
Oh boy. So continue to grow through real estate transactions, continue to increase our business. I'd like to, I'd like to continue with multifamily. I'm looking at some other asset classes as well. But the most important part is continue to grow and develop the business, grow not only the net worth, but grow the, monthly cash flow. I would like to have over $200 million worth of assets under management in less than 5 years. And that might be only multifamily, but it might be some of these other asset classes that I'm looking at, for instance, self-storage, light industrial, mobile homes. So just continue to grow and develop that. I'd also like to continue to grow and develop my mastermind groups that I've been kind of starting here. So I've been enjoying that a lot, and I'd like to continue to grow and develop those as well.
Sweet. Now that you're on there, tell us a little bit about the mastermind.
Yeah. So just a group of about 8 people, and we meet on like a Zoom chat, once a month. And then we have a physical meeting as well, and really just trying to dive into best practices and help everybody grow their multifamily business, their business in general, and mindset and all that kind of stuff. So it's kind of similar to like a coaching program, but it's not, it's not one-on-one. It's more synergy. I find that you get a lot done when you've got a lot of minds involved.
I like it. And, anybody out there, man, masterminds are powerful. I think, that is where you learn a lot, from guys that are at your level or higher. And, they're just, just that, as I said, they're powerful, and you got to really join one of those. So at the end of your life, Todd, how do you want to be remembered?
As a difference maker. And I want to be somebody who leaves this world a better place than when I entered it. And so I want people to remember the positive impacts that I've made on hopefully thousands of people's lives. I want to be able to give back through educating underserved youth, teaching them about business, teaching them about finances, teaching them about how to become something better than maybe what they would have otherwise become if I wasn't involved somehow, or my group, or my organization, or whatever. So I just want to be able to give back and really provide a difference in people's lives.
Love it. Where can Commit to Wealth Nation go to contact you and find out more about you and your company, and just if they want to get a hold of you and connect with you?
Yeah. So easiest way is just to go onto my main website, which is venturedproperties.com. So it's venture and then D as in Dexheimer, properties.com. They can find my podcast on there, Pillars of Wealth Creation. They can find my coaching, mastermind stuff on there as well. So they can find me there. And also connect with me. Feel free to connect with me on LinkedIn or Facebook. Those are probably the 2 best places on social media that I'm at as well.
Sweet. Okay, Todd. Well, hey, man. I mean, it was fun talking to you. I love talking shop. Especially with other multifamily syndicators. It really was fun, and thanks for sharing a lot of your information. Some of the mistakes that you made. That's really humbling. To from your side to to be able to hear your mistakes and also the successes that you had, man. It's really awesome. So thank you so much for everything that you provided for myself and for my audience, and I wish you continued success.
Well, Juan, I thank you very much for having me on the show and appreciate what you're doing as well. It's always great to be on somebody's show that's giving back as well. So,
CommitToWealth.com, creating a legacy by committing to real estate wealth.